Aguilar, Scott Snyder with Mellon Money Management. We're here today with our video series, Dude, Where's My Money? Talking about what to do with your portfolio when the market's taking a downturn or when it's hit its peak, different strategies from there.
Yeah, and really the reason why we're bringing this up is recently the yield curve inverted for those that are into technicals. What that means is the U.S. Treasury bond market for the 10-year Treasury, the interest rate on that side of it went lower than what you can get in a 3-month T-bill. So normally you'd think the longer you hold a bond, the more you're going to get paid for it. Well, the reason why an inverted yield curve is sort of perceived as a negative sign in the economy is that it's really the opposite of what you would intuitively think is occurring.
You're less incentivized to give money for longer periods of time.
Exactly. Yeah. So, and the reason that yield curve is looked at so anxiously by investors is it's been a pretty consistent signal for when there's an incoming recession. So it's predicted the last 3 recessions that we've seen since the 1970s, when there's been a lot better historical data to go off of. So we're not sugarcoating it and saying that there isn't a recession on the horizon. However, a recession and a bear market don't always coincide with one another, and I think that's where investors lose sort of sight of what to do with their money when things are at a top. Right?
Yeah, absolutely. And I think you see a lot of people trying to time the market versus just being time in the market. There's a big difference, and you see the difference in performance. If you miss on the top biggest 10 days in the market over the last 10 years or so, the average outperformance is around like 2 or 3%. So the difference is pretty drastic.
Yeah, it's 3%. I remember the statistic. It's 5% is what investors had earned if they just stayed in the market, kind of during that flat time period from the 1999 to basically 2018. Versus, so it was like 5.5% versus I think it was 2.1% or something for the investor that missed the top 10 days of the market. So, it's really been proven too there's a research study done by Dalbar where they show that the average investor underperforms the markets by 2% a year.
Right. Yeah.
So it's because they're trying to time it.
Exactly. And to be honest, it's a tough game to do. Right. I mean, we've seen it time and time again. People try and time one thing or the other, and even this year is a perfect example. So many experts thought the interest rates were going to go up. Yeah. Pretty much.
They thought it was going to go to 3%.
Every person you would have pulled at this time last year told you that in 2019 rates were going to go up. Well, it's been the complete opposite. Rates have all gone down. I think everyone would have completely played that wrong had they tried to.
This is the Wall Street Journal that did this research study and pulled 69 of the top economists. So it's not like these are stupid people. The point is, it's no matter how smart you are, it's incredibly difficult to predict what's going to happen in the market. And of course, you're going to have some hotshot out there that is going to be guessing when it's going to go down, and then say, "Look, see, I was right." Right. And they maybe were guessing for the last 5 years. Yeah. And now they finally hit it, and then they make a movie about it.
And I don't think the last thing we want to do is, because we get tons of clients who come up to us on a daily basis and worried about the market, whether it's hit a top, what to do, what should they do with their money? Should they be doing something different? And I'm not saying that everyone should be sitting on their hands completely, but
no.
I think it's very personalized. Certain people who are retirees should definitely be more conservative versus people who are in that accumulation stages. You've got more time on your hands. It makes less sense to be out of the market. I think that's very important to note. It's very specific to your frame in terms of how you're viewing the market and how you're using the market to benefit.
Yeah, your life stage, really.
Yeah.
And and fitting into your overall goals and objectives. I mean, that's really what we go back to with our clients, is making sure that your investments align with your overall goals and objectives.
Right.
And if you have the right goals and objectives and the investments aligned in cohesion, then it really doesn't matter what the markets are doing, because the portfolio is set up to work through all market cycles and rebalance, honestly, when things like this, like times like now, occur, where we're more at the top of the market. Let's say you had a 60-40 portfolio of stocks and bonds, so 60% stocks, 40% bonds, and that portfolio goes to 70% stocks, 30% bonds, because the markets were doing really well. What we can do is then rebalance the portfolios to shift it back to that 60-40 mix, and you're essentially doing the old adage of buying low, selling high,
Right.
and keeping everything within the comfort zone of what you can handle from a volatility standpoint as well. And really, the point of having more conservative assets like bonds and cash, and allocation more towards that when you're retirees, so that if markets do go down, because they will go down, you draw past your cash, well, you can tap into your bonds next, because they're much more stable, historically speaking, than stocks. So you can let your stocks continue to run up or let them rebound, so to speak, while things are going down, and wait for that rebound before you ever start withdrawing from your stocks again.
Right. Yeah. No, absolutely. And I think that tends to be the best way to shield yourself from these ups and downs, is being able to stick to your investment philosophy and the style of portfolio that you end up choosing, whether it's through working with your advisor or through what you've done on your research side in terms of the risks that you're comfortable taking.
Right.
Just making sure that your portfolio is aligned with that.
No, we're saying, there's some people that they may need to make an adjustment. If we're having a reality check and you're seeing your $500,000 portfolio down to $400,000, and that's freaking you out, we might want to look to change the allocation around to be more conservative, so that it's preserving what you have. But it doesn't mean that we need to make a drastic change. It just means maybe we dial it down a notch or two.
Mm-hmm.
So everybody's situation's a little bit different. We're just the biggest takeaway for today's viewers is really not to time the market, but to have a plan in place so that you can stay with your investment allocation through all times.
Right. Because there are things that we can do on the investment side to help protect you on the downside, but at the end of the day, what those things are market timing. And so it's not exactly what we would suggest people to do. It's what I think the best and most responsible move is to find that portfolio that best suits your risk tolerance.
Really, the statistics back it up, that trying to time the market doesn't work. And yes, there are one in a bazillion person out there that's going to get it right, and then they're going to toot their own horn. But really, you just got to take a step back from that and look at what is most likely and stick with that.
Yeah, no, 100%. I'm just trying to pull up some of the facts and figures that we went over.
Yeah, and another thing about just the inverted yield curve that the people might want to know is it takes about 17 months before a recession hits from when the point in time when the yield curve hits, or the yield curve inverts. So there's a lot of time that goes by before we even see the recession on average hit. The problem is a lot of this stuff is we're looking back in time and then kind of validating what already happened.
Right.
And that's why it makes it all this very hard to predict when it comes to the markets.
Being out of the market for those 17 months is going to hurt you probably just as much, if not more, than if you time it.
Eugene Fama, who's a very smart economist and a professor at the University of Chicago, did a study on it and showed that you're actually better off in periods of 1, 2, 3, and 5 years staying invested in the markets versus going to cash when the yield curve inverts. So there's a lot of smart people looking at this from a behavioral standpoint and seeing, okay, can we get an edge on this? And really what people are finding out is that the best thing you can do is just stay in the market, which it's the hardest thing to do, quite frankly, because we're all sort of wired to want to do something when something bad happens. It's like the primitive instinct in us to the fight or flight instinct.
Yeah, and sometimes, and it's sadly a lot of people don't realize what their true risk tolerance until they actually start losing money. So I think being able to go through that experience, or being able to kind of at least simulate it with yourself and understand how would you feel if that money is gone tomorrow is very important. Don't sit there thinking that the risk tolerance questionnaires that I know we give our clients before we start working with them, that they're
don't take them lightly.
Yeah, because they are very meaningful, and the way the portfolio is constructed is going to be around things like that. So make sure that you're going through those exercises when you're trying to put together what your money is invested in.
100%. And I mean, I think the best way to frame it up when you're looking at it is pretend you have $1 million, and what number will it go down to before you get really, really uncomfortable? Because quite frankly, the bigger that dollar amount people have, they really notice the losses more. I mean, a 50% loss, which has happened quite frequently in the market, you can lose. I mean, your $1 million is down to $500,000. That's a big loss. But know that if you just stayed in the market, you would have been fine. Yep. It's those people that need to withdraw from the money during retirement, where that's really the most detrimental impact on them. And that's why we say insulate yourself with more conservative investments like bonds and cash to supplement it. It's not everything needs to be in the stock market by any means, but it's how you go about the overall planning part of it that really dictates how we protect ourselves in these down cycles, because they will happen. But the long-term trend of the stock market since the Great Depression era has been a 10% average return. It's been historically one of the best places for returns and anywhere else.
Mm-hmm. And just don't let one bad month or one bad year turn you away from it, because in the long term, it is what history has shown to be a beneficial strategy to do.
Yeah, I mean, it's quite frankly, a lot of the worst days are followed up by some of the best days. That's why we say trying to time when to get in, when to get out is so difficult, is because it's the volatility when it's high, it's on both ends, both the up and the down. And so we just think that if you have the right mindset, that you'll benefit more, and why investors that do stay tend to outperform.
Yep.
And stock market isn't for everybody. So, just keep that in mind. Really look at your overall needs too.
Yeah, and it has to come back down to the individual investor and what's right for you. Scott wrote up a great article. It's on our website, on our blog, that speaks a lot to this and recaps a lot of what we talked about today.
Yeah.
I definitely would suggest if you kind of want to get more into the weeds of it, you can look back into our website and look at our blog and look for his post.
It's called The Yield Curve Inverted, What Should Investors Do? And there's a lot of hyperlinks in there that you can click into to get research from other places. So for those that really want to understand what's going on, there's a wealth of information for you to pull from. Hopefully you guys enjoyed today's episode, and look forward to bringing you more here down the line. Thanks so much.